In this video, I'm going to talk about how to manage a position when you have FOMO and you're like, oh my gosh, I'm missing out. It's moving without me. What can I do? Pretty easy. I'm going to give you 2 strategies that you can implement if you feel like you're missing out on a trade, it's running without you, and you're like, oh my gosh, I need to get in, but I have FOMO. You know, you have the fear of missing out. You know, you're buying high, but could it keep going up? Sure. Or could it keep going down? Sure. 2 strategies. Very, very easy. The first one is extremely simple. Let's go look at Marvel. Here on Marvel, the stock has just been absolutely scorching the earth for a very, very long time. So, number one, in a situation like this, if you look at this chart and you're like, oh my gosh, Marvel's at 284. It's going to go to 300. I'm not in the trade. I'm missing it. Well, number one, you probably shouldn't take the trade. But number two, if you have to, first strategy is buy small size. Buy 5 shares, buy 1 share, buy 10 shares. Buy a small starter position so that you're at least in. That's number one. Number two, then begin to plan when you should get in at a better price. Analyze the chart. Try to get an order on a pullback. Look at the chart and say, what type of gap is it getting? Is it actually going to pull back? Can you put in limit orders to try to get more on a retracement? The answer is almost always yes, by the way. You're almost always going to get in at a little bit of a cheaper price if you put in a limit order to try to catch some more. So you buy small size, you buy your share, you buy your 5 shares, you buy your 10 shares, and then you actually do some math. You sit down, you do the time of like, all right, how can I get into this trade with a smaller position? And you get into this trade with a smaller position. And then, of course, you say to yourself, all right, I want to buy some type of pullback. Cool. That's probably the best way to do it. That's number one. Strategy number 2 is what's called a bull call spread. This is actually a debit spread. I will show you how to set this trade up inside ThinkOrSwim. It's relatively easy, but to explain it, what you're doing is you're buying a call and you are selling a call simultaneously. So on this trade on Marvel, if I buy a 270 call option, right? Buying to open a call option, buying to open a call option is a strategy that you only want to do if you are quite confident the stock's going to go up. Now, what's nice about the option is you don't have to spend that much money. Options are cheap. So they give you limited downside risk for, a really nice upside return. So buying to open a call option is a cheaper way to own the stock without spending a lot of money on the actual stock itself. Now, obviously, the more options you buy, the more your risk. So buy 1 contract, buy 2 contracts, buy a contract if you want to, so at least you're in if it does continue to move higher. And simultaneously, I'll show you how to do this inside ThinkOrSwim, which is the same way in Charles Schwab or anything else. You are also selling a call option against the call option that you own. Sell to open a 320 call. What this does is it creates a small hedge so that if the stock does actually go down, which it almost always does at some point for a period of time, now the call option that you sold decreases in value. So if you sell a call, and we're going to look at this exact transaction in just a moment because it's actually not a terrible stock to do it on. You sell a call, stock goes down. Let's say you sell a call for $3, stock goes down, and you can buy to close that option for $1. You've made $2 on the hedge. However, the call option that you bought is definitely decreasing in value, which, you bought high anyway. So you can use the profit, this $200, to maybe buy another contract. Or you go, all right, well, hey, at least I got paid to be patient. I'm going to use that $200 to buy a half a share of Marvel. Or, hey, I got paid to wait. I knew I was buying high, and at least I decreased the cost of that purchase, and now I can hold my original call option for a little bit longer. And the other good news is, if the stock does absolutely rip and just continues to go higher, you are going to make money all the way up to 320. Once it goes above 320, you're going to get what's called delta capped, and you're no longer going to make money on that position. However, you will make the overall net profit 270 up to 320, which is $50 total. So this is your total profit on a bull call spread, which is a debit spread. You're going to be paying money for this trade. The max amount of money you can make is $50. That's it. $50 minus the cost of the transaction. Can't spell transaction. So $50 minus the cost of the transaction. So let's just go look at what that actually visually looks like inside ThinkOrSwim, or again, essentially, obviously, any other platform that you're doing it on. So here's Marvel, and I want to do a July call, so I'm buying some time, and I'm going to buy the 270. Okay, so the $270 call is going to cost, wow, you can only sell 320. Perfect. So if you're buying a call option at 270, you're going to spend $46 approximately. Maybe it's smidge less. And the 320, you're going to be able to sell for approximately 230. So to do the math, you buy for 46, you sell the option for 27.30. Your total cost on that trade is going to be approximately $1,800. Technically $1,870 per contract. That is your total expenditure. Okay. So your total spend is $18. And what's the total amount of money you can make on that trade? The total amount of money you can make on that trade is a $50 profit. That is max. So you're spending $18 to potentially, best case scenario, make 50. So again, the risk reward is still there, still nice. Here's how you would actually do that trade, and at least ThinkOrSwim. You would right click this and go to buy vertical. Then you'll notice the +1. This is the option that you're buying. -1 is the option that you're selling. So I come in here, 320, and this is the cost of the two transactions together. You'll notice it says $18 debit. This is the mid price, 1805, which is probably like the best you can get. So if I'm like, yeah, no, I'm buying a little bit high, I can buy at $18 and see if that trade fills. If that trade fills, and at any point in time, Marvel goes down, I can easily buy to close this option for a profit. And I still have the losing trade that I'm holding, which is the 270 call. Again, essentially in hopes that it does go higher eventually, which would look like on the chart, it would look something like this. Boom, it goes down, you buy to close the 320, and then the retest gap and the trend does its thing, and then hopefully Marvel continues to go up. And now you own the 270 call uncapped, you have a July expiration, and the option can start printing money, hopefully, if the trade continues to go higher. That is the only way to make money in an option. If you're buying a call, is the stock has to precipitously go up in value. If you buy a call and the stock does not go up, you're going to lose. But what is nice about this transaction is you do have a hedge so that, again, if it does decrease in value, you can buy to close the short call, bringing in some capital. And depending on the trade, you can use that capital to either A, buy some shares for free, B, maybe buy more of the call option that you own. And then, of course, you need to place a stop loss on the call because if the stock does continue to do this and it does not go up, you don't want to lose all of your money on the call option unless that was your intentional goal with the overall trade. That is a bull call spread. It does require option level 1, maybe option level 2, depending on what broker you have. It's not an option that I teach very frequently because, like anything else, it's all about timing. The truth is, family, all trading is timing. When people say you can't time the market, don't listen to them. You can time the market. You can't time the market perfectly. The market opens at 9:30 every day and closes at 4. You can time it. Timing it correctly is the key. Since we're here, and again, obviously I don't have any position in Marvel, let me at least show you how you could time it a little bit better if you're going to get into this position. This was the first bear above the 10 EMA. You know you have earnings coming up, so you're not going to get into an option over earnings. Bull candle gaps up on earnings into a retest gap, and the stock pulls back into the 10. This would have been the opportune time to buy, obviously in a bull trend on some level of pullback. If you bought Marvel calls, you're extremely happy today. You got rewarded. If you bought stock, you're extremely happy. You got rewarded. If you sold puts, you got rewarded because the stock went up. If the stock does anything other than go up, if you're in a bull position, you're going to lose money. It's just the way it is. It doesn't matter the strategy. However, if you bought an option here and you sold an option here, getting into a bull call spread, you have totally capped your profit. Congratulations. You have reached your maximum potential. Congratulations. And then you can sell that spread as a trade. You go into your trade, you select the trade, you click sell to close the entire position. That will be a net credit. The debit, because you spent money, you sell the position for a net credit, you make money, and those two, hopefully, if your net credit, if the stock goes up, is more than your net debit, you have created a cash flow winning position. Those are really the only two strategies that I generally recommend if you feel like you have FOMO and you know you're buying high, but the stock could go higher. Take a small position or get into a bull call spread, and best of luck.